Okay, today we're tearing down the ProShares Short VIX Short-Term Futures ETF. You might know it by its ticker SVXY. We're going to look at how this thing works, its pretty wild history, and the massive risks that are baked right into its DNA.
So here's the big question, right? How do you actually make money when markets are just quiet? And maybe more importantly, how can that quiet completely shatter in like the blink of an eye? The whole idea behind SVXY is an attempt to answer that. And it all comes down to a concept that's at the absolute core of the market's fear gauge, something called implied volatility.
Now, implied volatility. This isn't about what happened yesterday or last week, not at all. Think of it as a real-time prediction. It's the market's collective best guess about how much the stock market is going to swing around over the next 30 days. And where does this number come from? It's pulled directly from the prices people are paying for S&P 500 options right this second.
And you've got to understand this difference because it's everything. Historical volatility, that's just looking in the rearview mirror. It tells you how bumpy the ride was. But implied volatility, that's the market trying to look ahead through the windshield, guessing at how bumpy the road is gonna be. And that's the whole game for SVXY. Its entire strategy is basically one big bet against that future expectation.
Okay, so this gets us to the core economic idea here, what's known as the volatility risk premium. It sounds complicated, but the concept is pretty simple. See, investors are usually willing to pay a little extra for what's basically portfolio insurance, options. Because of that, the predicted volatility often ends up being a bit higher than what actually happens. SVXY is built to be the insurance company in this scenario. It's designed to just systematically sell that insurance and collect that little bit of extra premium day in and day out.
All right, so let's talk about the engine of this thing. Now, what's interesting is that how this strategy makes or loses money, it doesn't really come from the VIX index itself. Nope, it all comes from the market for VIX futures. The actual shape of that futures curve, that's what makes SVXY go.
Most of the time, the VIX futures market is in a state called contango. All that means is that futures contracts for, say, 6 months from now are more expensive than contracts for next month. You get this upward sloping curve. And why? Well, it's because the market generally expects that today's calm won't last forever. It assumes volatility will eventually drift back up to its historical average, so protection further out in the future costs more.
And this contango situation, it's like a built-in tailwind for SVXY. The fund goes and shorts those pricier, longer-dated futures. Then as each day passes, those futures contracts just naturally get cheaper as they slide down that upward sloping curve. It's like an apple rolling downhill. The fund then buys them back for less than it sold them for. That profit is called roll yield, and when markets are calm, that's where the money comes from.
But then there's backwardation. This is the complete opposite. This is what happens when the market panics, some big sudden shock hits, and everybody scrambles for protection right now. That insane demand for immediate insurance makes the near-term futures price shoot way up, even higher than the longer-term ones. The whole curve flips upside down. And when that happens, the whole engine just slams into reverse. Now the fund is shorting something that's getting more expensive as it approaches expiration. It's forced to buy back its short position at a high price and then sell a new one at a lower price just to stay in the game. You're basically locking in a loss every single day. And that negative roll yield just eats away at the fund's value, even if the market isn't in a full-blown free fall.
So, that's the engine. But what about the vehicle itself? How is SVXY actually built to capture all this? Well, before 2018, its design was, well, let's just say aggressive. It used full inverse leverage. The goal, for years, was simple. Deliver the exact opposite return of the VIX futures index every single day. So if the index went up 1%, SVXY went down 1%. And you know what? In that super calm market we had for years after the 2008 crash, with contango just chugging along, this thing was a monster, an absolute cash cow, billions of dollars poured into it.
But all that success, it created this illusion that it was easy money, just a machine that prints cash. And that whole perception was absolutely obliterated in a single afternoon, an event that traders now call Volmageddon. I mean, look at this timeline. Over basically one weekend and a Monday, the entire mood of the market flipped. We went from total calm to sheer panic. The VIX more than doubled in a day. And for the futures index that SVXY was shorting, well, the effect was nothing short of catastrophic. Get this. In a single 24-hour period, from the close on February 5th to the close on the 6th, the index that SVXY was designed to short, it didn't just go up, it skyrocketed. It jumped by 96.6%. And the math here is, well, it's brutal. It's inescapable. If your whole reason for existence is to deliver the negative 1x return, and the thing you're tracking jumps 96.6%, you lose 96.6%. Just like that. SVXY was almost completely wiped off the map. Its biggest rival, a fund called XIV, actually was. It was terminated, gone.
So after all that carnage, ProShares had to re-engineer the whole thing. They changed the fund's objective. Now, it only targets half the inverse return, so minus 0.5x. That means if we had another Volmageddon, that same 96.6% spike would only cause a 48.3% loss, which is still, absolutely devastating, but it's not a death blow. The fund could survive it. But here's the thing. The most dangerous risk wasn't totally fixed.
Because the biggest long-term threat isn't another one-day explosion. It's something much quieter, almost hidden. It's a mathematical certainty that's just baked into the way these daily rebalancing funds are built.
So think about this for a second. Let's say the underlying index goes up one day and then comes right back down the next day, finishing flat. How is it possible that you, the investor, have actually lost money? The answer to this really shows you the corrosive, value-destroying effect of holding one of these products for more than a day.
Okay, let's just walk through the numbers. Say you start with $1,000. On day one, the index jumps 20%. Your fund is negative 0.5x, so it falls 10%. Your $1,000 is now $900. Easy enough. But on day two, the index falls right back to where it started. So your fund goes up, but the percentage gain is calculated on your new, smaller amount of $900. So you end up with $975. The index is exactly where it started, but you're down almost 2.5%. That's called volatility decay, and it's a killer. It's a direct consequence of that daily reset.
So when you consider all these risks, it's no surprise that the fund's own paperwork is crystal clear about who should and who should not be using this thing.
Look, at the end of the day, SVXY is a tool for expert short-term traders. Full stop. It's not a buy and hold investment. It requires you to be constantly watching it, to have incredibly precise timing, and to have a deep, deep respect for how violent market volatility can be. Anything less than that, you're not investing. You're just gambling against a force that has already shown it can wipe people out in the blink of an eye.